Hi there. My name is Victor Louis, and I'm the head of investment advisory at Sankore Global Investments. And this is your weekly financial market updates. We start off in the US, where stocks climbed on Friday as the three major averages posted their first positive week of 2025. The Dow Jones Industrial Average was up 78 basis points. The S&P was up 1%, while the Nasdaq gained 1.5%. Big tech stocks were higher, on Friday. Tesla, Nvidia, Alphabet were all higher on Friday. For the week, the Dow advanced 3.7%. The S&P rose 2.9%. Both indexes posted their biggest weekly advance, since the week of the U.S. presidential election in November. The Nasdaq was up 2.5% for its best 1 week performance in about 7 weeks. Market sentiment, was significantly buoyed last week on, softer inflation reports. We saw, core CPI and also headline CPI, essentially coming in line with expectation and slightly below, expectation. This essentially created some positive sentiments, in the market. We also saw the 10-year US Treasury pull back quite sharply as the hope for multiple rate cuts, basically rose, for this year. Also last week, we also saw, really strong, earnings from major banks, and this also really supported sentiments very strongly. Shares of JP Morgan, Goldman Sachs, Citigroup were roughly up about 12%, for the week. Going into the remainder of this week and this week really, market essentially will be looking very keenly at the inauguration of President Donald Trump for a second time, basically looking out for key moves that will be made via executive order, particularly, in this first week. A lot is really being expected. So again, market will really keep a close eye on that, and that will really have a really strong, impact on, what happens to the market, at least in the near term. Over in Europe, the German economy contracted by 0.2% in 2024. This is its second consecutive, annual slowdown. And this drop was really in line with expectation. The German economy really has been bogged down with a myriad of challenges, ranging from a house building crisis that's been occasioned by a high interest rate environment, several key industries, particularly the auto sector, continues to struggle with the transition to electric vehicles, and also very, very stiff competition from Chinese automakers. Growth in the UK was also lackluster, came in at 0.1% for November. This was lower than the 0.2% growth that was expected, and was, however, better than the 0.1% decline that we had seen, in October. The slight growth really could be attributed to the service sector. While the growth was meager, it really is the first sign of life in the UK economy over the last 3 months. The British pound fell against the dollar on the back of this sprint. Analysts now expect that, this would fuel the case for rate cuts by the BOE when it holds its meeting on the 6th of February this year. Nevertheless, the BOE really will be keeping an eye on inflation. On the geopolitical front, particularly in the Middle East, Israel and Hamas reached a ceasefire and a hostage deal, which is essentially kicked in over the weekend after a 15-month-long conflict that had created very serious destruction and also inflamed tensions across, the Middle East. The ceasefire is expected to be in 3 phases. The first phase would basically include a full ceasefire and the withdrawal of Israeli forces from populated areas of Gaza. This is expected to really dial down the tension in the Middle East. And this obviously would have implications for crude prices and, tensions within the area, really. The hope is that this ceasefire holds through and, continues. Over in China, last week released, Q4 GDP, where we saw economic activity really accelerate in the final 3 months of last year. GDP expanded by 5.4% in the fourth quarter, beating an estimate of about 5%, and also outpacing the 4.6% that we saw in Q3, 4.7% that we saw in Q2, and the 5.3% that we saw in Q1. So this last quarter sprint essentially brought full year GDP to 5% for 2024, which was essentially, the target that the Chinese government had set. So clearly, the stimulus measures that were implemented in September, I think we're beginning to see the impact of that sort of start to kick in. Although market is still looking for even more stimulus, particularly on the fiscal side. But I think that the impact that we're beginning to see could be something to write home about, as the government would want to weigh the impact of those monetary policy stimulus and then be able to figure out what next it might need to do. Over in Nigeria, really the fixed income market was largely mixed in the course of the week. The treasury bills market attention was really concentrated on longer dated bills. We saw yields sort of pull back within the treasury bills market. Also in the bond market, it was a bit lackluster. The market really was looking out for that, auction calendar, which was eventually released, in the course of the week, and included the issuance of a new bond, a new 2035 bond, or a new 10-year bond, really. And also last week we saw inflation data also coming at 38.4%. Really, this was not unexpected. Typically, we'd see a lot of spending going in December. So I think that this surge, particularly for that December number, can be attributed to, all of that spending that happened in December. So we expect to see some moderation going forward. But our inflation, obviously, will be tied to what happens in the global crude oil situation. If crude oil prices stay stable, then our inflation would likely stay stable. However, if we see a spike in crude oil prices, it will certainly affect pump prices locally and by extension, our own inflation here in Nigeria. So that's pretty much it in terms of, our wrap from financial markets last week and what our expectations are for this week. I think critically, the markets will basically be looking out for what Donald Trump does in his first week in office. And that is likely to really, really drive, market sentiment in the near term. Thank you very much for your time. We hope that you have a very, very productive week. Thank you.